Now we come to the causes of financial crisis. That means, what are the factors that cause this crisis to happen? Right? Now we will discuss the causes of crisis now. The first one, they say financial crises are mainly occurred due to asset price and credit bubble burst. What is this bubbles? Asset price bubbles and credit bubbles. Always when there is a bubble, we know the bubble is going to pop up. Bubble burst. So when there is a bubble, it will follow up with the bubble burst. Now, normally all these historical events or historical crises in the economies have been resulted because of this asset price or credit bubbles. Then let's discuss what are these bubbles. Asset price bubble means it's a sharp increase in asset prices. If there is sharp increase in asset prices, we say it's an asset price bubble. But these prices are extreme form of deviations. That means normally prices are increasing, that we know. But these increase in these deviations are sharp increases. They are highly deviate from the standard predictions. So they are deviate from the predictions. Unanticipated, sudden, strong increase in prices. That is a bubble. So these examples for such asset price bubbles are, you can refer later these terms. You can surf in internet and find information. As an example for this asset price bubbles, Dutch tulip bubble, we say French Mississippi bubble, and in the subprime mortgage market in US, that is again asset price bubble, housing price bubble. So these are some historical evidences that we encountered with these asset price bubbles. So how this bubble occurs? That is the problem. Why there is a sudden increase in the asset prices? Normally the first reason, when flexible monetary policy changed to a tight monetary policy. Let's discuss step to step. So please listen carefully this part, because this is very critical to understand the rest of the part of the lecture as well. And the problem here is we are doing the online lectures. I do not have the whiteboard. The whiteboard which is there in the Zoom is a bit of difficult to operate. So if we meet in a classroom, we can discuss it in a more effective manner, but I will try my best to give you the picture. Just get this concept step by step as a flow diagram. If you are making notes, just use arrows and make a flow of these steps, all right? The first step is the flexible monetary policy. Now the economy has a flexible monetary policy. When there is a flexible monetary policy, central bank inject money into the economy. That means interest rate is lower in the economy. The first step is the flexible monetary policy. It will result, the second step, lower interest rate. When the interest rate is lower in the economy, what will happen to the credit demand? It will go up, right? When we have a lower interest rate, taking loans is cheaper. So people will demand more and more loans. So the third step is the credit demand will be increasing. Credit demand or the credit issuance will be increased. And in that situation, what about the default risk? It is low, right? Why? The interest rate is low. That means the people have to pay a small amount of interest. So the default risk is lower compared to the higher interest rate. When we have a lower interest rate, default risk is lower. So the people have more money with them because they can access to loans with a lower borrowing cost. Then, but for what type of purposes they use this money or lended money, that borrowed money, for what type of purposes will they use? Normally at that time, I'm referring to the global financial crisis, but anytime when people have excess money, they go for investment. Most of the time, it's the investment in the real assets. Because when there is an asset price, when the prices are increasing, investing in real assets are beneficial for them. Why? They can gain a capital gain from investment in the real assets because the prices are increasing. They can buy at a lower rate and sell at a higher price. They can gain a capital gain, right? So what happened? Because of the flexible monetary policy, interest rate is lower, so the credit demand is higher and the default risk is lesser. So they will use this borrowed money to demand the real assets. So the demand for the real assets will go up. When the demand for the real assets is growing up, what happens? Higher the demand, higher the prices. So the prices of the real assets also go up, right? When they demand more and more real assets, the prices of the real assets also go up. When the prices of the real assets are going up, what happens? The people again motivate to invest in real assets, right? Because now they know the price of the particular asset is going up. That means it's better to invest in this particular asset that they will earn a capital gain later because they can purchase at a lower price and sell it in the future at a higher price, thereby making a capital gain. And similarly, the bank also will promote the further loans. Why? Because normally when they observe this price pattern in the economy, higher asset prices, the bank also know since the people are taking loans to buy this asset, and also the price of this asset is increasing, the bank knows there is no risk of giving the loans to this investment because for sure they can make profits from this investment and pay back the loan. So they will issue more and more loan. Then what happened? We call it the increase in prices of this real asset, the asset price bubble. Where it started because of the flexible monetary policy with lower interest rate. So they demanded more real assets. It created higher prices in the real assets. So that is the asset price bubble. Asset prices went up, bubble. That asset price bubble promoted the credit bubble as well. When there is a higher prices in the asset, people demanded more and more credit to buy this particular asset. So the higher the asset price, higher the demand for the credit also, credit bubble. So always asset price bubble promoted the credit bubble. And it can happen other way around as well. Credit bubble promotes the asset price bubble. How? When the commercial banks give more and more credit, people will invest more and more in real assets. That will increase the prices more and more. So the asset price bubble promotes the credit bubble. Similarly, credit bubble promotes the asset price bubble. Right? So that's how the bubble occurred. Now we are going to talk about how this bubble is going to burst. It goes with it happens when the flexible monetary policy changes to a tight monetary policy. Now the central bank tightened the monetary policy. Then what happened? Interest rate is going up. Interest rate is now higher when the monetary policy is tightened. Then what will happen to the demand for the real assets? It will go down, right? Why? Now taking loan is costlier. So people will do not demand loans, thereby they do not have enough funds to demand for real assets. So the demand for the real assets also go down. Then what will happen to the price of the real assets? When the demand going down, that means the prices also going down. So that means asset price bubble started to burst. Asset price bubble burst. When the prices starting to fall, it is the bubble burst. When there is an asset price bubble burst, that means asset prices are starting to fall. Then what happened? Then the investors face capital losses from the selling real assets. Why? Now the prices are lower. They have bought the real asset for a higher price. Now they have to sell the asset in a lower price. Capital loss. When they face capital losses, what will happen to the repayment ability of them to the credit that they obtain from the bank? The default risk is higher. When the people who obtain the loan faces the capital losses, they will start to default the loan. They will not pay back the loans that they taken from the banks. Then default risk is higher, then it is a loss for the commercial banks, right? Then what happened? The banks also will prevent from lending now. They will reduce their credit. So the credit issuance is reducing means, in other words, credit bubble burst. Credit also going down. Now you know how the asset price bubble burst create the credit bubble burst. I suppose now you are familiar how the bubbles are converted into bubble bursts when the flexible monetary policy is changed to a tight monetary policy. Okay, so that's the main reason for the financial crisis, these asset price bubbles and the bubble bursts. Let's explain how this happened with the historical example from the global financial crisis. Now, the second reason, when there is a strong relationship between banks and financial market, again, the same reason for a crisis. When the informations are circulated rapidly with the parties, the bank, in the financial market, then when there is a strong relationship between the bank to bank, then what happens? When one bank fails, other banks also start to fail. Crisis. And when there is poor risk management in banks and other financial institutions and excessive speculation, what is a Ponzi scheme? Ponzi scheme means it's an investing scam. That is a scam. So in a Ponzi scheme, the interest is paid to the investor using another's deposit. That means it generates the returns for the early investors by acquiring new investors. This is far similar to pyramids. But the difference between the Ponzi scheme and the pyramid scheme is, in Ponzi schemes, the investors do not know that their returns comes from the new members' deposits. But in the pyramids, they know. When you join into a pyramid scheme, you know that if you attract or if you add new members to the scheme, you can get a payment or interest. In the pyramid, you know that. But in the Ponzi scheme, you do not know that. So what the people do who manage this Ponzi scheme, they collect the deposits from the new members and pay the returns for the old members from the deposit of the new members. They are not going to invest in a productive use, rather they pay the interest from the deposits itself. So that's a Ponzi scheme. So this Ponzi scheme can also can cause a financial crisis. Then what are the unfavorable effects of financial crisis? Here you can read and understand these all facts. Huge lack of funds for investment, loss of financial investors, economic downturn, all these are you can understand by just reading. An increase in budget deficit of the government. How that happened? When there is a financial crisis, ultimately central bank and the government has to interfere to make solution for the financial crisis. Then normally the government is liable for the depositors. Sometimes government interfered to save this systematic big banks, too big to fall banks. Then that will cause a huge budget deficit for the government. Social problems, depression, suicides. You are familiar what happened when the Ponzi schemes by Sakpiti failed, right? People lost all their deposits. So the government has to interfere and to give the solution for the damaged parties. It will create a deficit, budget deficit for the government. And what are the actions required for eliminating and resolving of financial crisis? What are the actions required? Here also these actions also you can read and understand. The government supervision. Always government or the central bank has to have a proper monitoring system or supervision mechanism to observe what the banks and the financial institutions do, right? So then they can observe if the particular commercial bank is engaging in high risk activities, then they can warn that bank. And deposit insurance and investment insurance, that means they provide an insurance facility. In a case of a bank fails, what happened to the depositors? Another insurance company will refund them likewise. So the lender of last resort, that function we discuss in detail. So the government can guarantee on bank deposits, government intervention to bank administration. So that happened with the Ceylon Bank. When the Ceylon Bank started to fail, what the government did, the management, the board of management was changed, and the government authorities or government officials were added to the board of management of the Ceylon Bank, and they prevent the Ceylon Bank from collapsing. So here you can read these at home and understand. These are very easy to understand, all these actions. And issues in financial stability programs. So these actions are taken by these government institutions or the central bank. We say that financial stability programs, right? So they always come and defend the commercial banks or financial institutions from collapsing, thereby protecting the financial system's stability. But the issue with these stability programs are, the first one is the moral hazard problem. What is the moral hazard problem? That means this particular commercial banks or financial institutions engage with the high risk activities that make themselves vulnerable for the crisis. But they expect government or to central bank to help when they fail. So that's the moral hazard problem. If they invest in high return, high risk activities, they always ignore the government regulations and the instruction. Always, you can also witness that central bank always make aware the people, do not invest in pyramid schemes, do not invest in these pyramid schemes. But what the people do? They invest in those. But when the pyramid scheme collapsed, when they lost their deposit, they rely on the government to recover their money. So they ignore the instructions given by the government or the central bank. But when they fail, they rely on the government to help. That's a moral hazard problem, right? And the burden on public or the bailout cost, what is meant by that? That means always these commercial banks or financial institutions, they engage with high risk, high return activities. So when they earn profit, that profit is for the private individuals or for that particular bank. But if they loss, then the government has to bear the cost and to protect that bank. Then the loss is with the government. Do the government bear the loss? No. Ultimately, that loss was imposed on the society. From where the government find the money to inject into this failing financial institution? From the tax money or else from the borrowed money, right? That means ultimately the taxpayers or the general public bear up the losses incurred by these financial institutions because of their riskier activities, but not public. And the too big to fail bank problems, earlier also I explained. There are systematically important banks. What is that systematically important bank? That means if that particular bank collapses, the government or the central bank knows all other banks also going to collapse. That much important that bank in the system. Because of that, when there's too big to fail bank has a problem, government anyway interfere and protect that particular bank. So this big bank also knows that. They also knows if they fail, government is there to support them. So they will engage in risky activities. Knowingly, the government will help them out, right? So they have these resolution plans or living wills, we say. They have proper documentation. But practically, these documentations do not do the job. There is an issue in these stability problems. These are the issues, right? It is very difficult to predict the financial crisis. From crisis to crisis, situation is different. But it cause was different. The solutions or the precautionary actions taken was different. So we cannot prior confirm that this is the crisis that going to happen and this is the program that we are going to use, right? It's very difficult to have an environment which is free from financial crisis. Now we are coming to the global financial crisis. Global financial crisis. So actually, why we say that this is a global financial crisis? Because even though it started from USA, it spread to the other countries as well. Because the monetary system or the international monetary system has become globalized. We are now in a global financial system, not a domestic one. Globally interconnected all the countries in the world. So when one country fails, it can severely affect the other countries as well. Because all the institutions, all the investors, debtors, borrowers, lenders, everyone are connected in one huge system, global financial system. So this global financial crisis in 2007, it hit advanced economies hard but spread it to the global trade as well. So it caused a global recession, if you can remember. It resulted bringing down global financial system. Actually, this started in the mortgage market or the housing market in USA. Before coming to that, tell me what is a mortgage? Suppose that you want to buy a home. Now you do not have the money. Now you go for a bank and you borrow the money from the bank to buy your house. So when the bank is giving you the money, they make a document called mortgage. That document is with the bank. So that's the agreement that you agree to pay the interest and the principal from the amount that you borrowed from the bank. If you default, what the bank do, they will sell your house that you purchased and recover the debt that is given to you. That's the mortgage. Now, in the US, always when we are talking about this global financial crisis, we discuss about subprime mortgage market. What is this subprime mortgage market? So this subprime crisis caused three reasons. Three reasons caused this subprime crisis. The first one is the low interest rate, which had been kept at low levels for too long. The US had a low interest rate for a long period of time. So that's one reason for the global financial crisis to cause. We will explain in detail how these reasons cause the crisis actually. The second reason is the deterioration in lending standards. Deterioration in the lending standards that resulted in loans being made to borrowers with poor credit quality. Deterioration of the lending standard. It resulted giving the money for people with poor credit quality as well. And the third reason which caused the global financial crisis is the financial innovations. We say it's amplified risks due to the lack of transparency with the use of new financial innovations. So these are the three main reasons underlying this global financial crisis. What are the three reasons? Low interest rate, which was maintained for a longer period of time in USA. Secondly, deterioration of the lending standards, which made the loans given to the poor credit quality people also. Thirdly, the high risk resulted due to the lack of transparency of the new financial innovation. So now we are going to discuss these three reasons in detail. First one is the lower interest rate. Okay. Here, in 1990s, this US continued a boom for a long decade. Over a long decade, they had a boom in the economy due to a productivity gains from the internet revolution and the stable macroeconomic conditions. So over a decade from 1990s, they had a stable macroeconomic condition and some productivity gains from the internet revolution. What is this internet revolution? That means that time the share prices or the stock prices of the companies related to internet facilities or the networking companies, internet related companies, they were rapidly increasing share price. So this was called as dot-com bubble. Again, bubble, asset price bubble. So the share prices of the internet related companies was in a boom. So it created the dot-com bubble. I told you every bubble is followed with the bubble burst. So this dot-com bubble burst happened in 2001. When the dot-com bubble burst happened, household wealth eroded severely. Why? Because the people have invested in these shares of the internet related companies excessively because of the asset prices, share price bubble. When the bubble burst, their net worth become eroded. Then again it resulted severely weakening US corporate sector. US corporate sector also severely weakened due to this dot-com bubble. And again there were terrorist attacks also in the US economy. All these reasons together created a financial panic. Accordingly, as a solution for this particular distress situation, Central Bank of the USA, Federal Reserve Bank, they lowered the interest rate up to 1.75 of the Federal Reserve rate. They lowered their interest rate due to the dot-com bubble burst, terrorist attack, and this distress situation in the economy. Then, in 2000 to 2006 time period, US housing prices rose by more than 80%. Now, asset price bubble disease. Why it happened? Because of the low interest rate, it made the borrowing cost down. Again, I am explaining. Because of having a low interest rate, borrowing cost is low. So when there is a lower interest rate, people push to seek investment in assets that yield higher returns than the bank deposits. Obviously, when the interest rates are lower, you are not going to invest in the bank in deposit. Why? Because you can earn less interest payment, less interest income from the bank deposits. Because of that, you seek for another investment opportunity. Taking a loan is beneficial at that time because of the low interest rate. By investing in the bank deposits is not beneficial. So at that time, the most accessible or most popular investment opportunities were with the stock market and the housing schemes. So if you invest in this housing industry, then you can earn rent and also a capital gain, right? If you purchase houses using this borrowed money, then you can rent these houses, or else since the prices are going up, you can sell the house later for a higher price and earn a capital gain. Due to that, since the people started to invest in real assets, particularly in the housing schemes, housing and stock prices increases. I told you the two most favorite options to invest was stocks and the housing. Share market and the housing market. So when there is a higher demand for the share market and the housing market, the prices of the houses and the shares went up. When suppose now that you are a person who purchased the house. Now due to the higher demand, the price of the house increased. Then what happened to your net worth? Your wealth is increased, right? Normally how we express our net worth based on the asset base that we have. How many houses we have, how many vehicles we have, how many deposits, FDs we have. Likewise, we measure our net worth or wealth. So when the people bought houses and when the prices of the houses went up, that means their net wealth also going up. When their net wealth is higher, that means they can easily access for another loan. Why? Normally what the banks do, they access a collateral. So that means how much net worth that particular person has. So when the prices of the houses increase, their net worth also increase. Then the bank sees there's no risk of giving the loan to that particular person because he is having a higher net worth. That enables them to borrow more. Then what they do, they take another loan to invest in their second or third home. So likewise, people bought many houses. Since the houses prices are increasing significantly and the low interest rate make them to get more and more loans. Now you can see asset price bubble is there with the housing prices and also a credit bubble is there because the banks allow the people to get more and more loans to invest in the housing. Right? That's the first reason, lower interest rate. Secondly, I told you, second reason that caused the financial crisis was the deterioration in the lending standard. Now I am going to explain that reason, deterioration in lending standards. First, bank lend to the people with good credit quality. They assess their net worth, their employment, their income, sources of revenue, everything and made the loan for them. But later, what happened? Pool of the borrowers with good credit quality exhausted. Why? Now already they have given the loans as much as possible to the good credit quality people with the good credit quality. Then what they did, they target the borrowers with low credit quality as the next level. Those are the people who call subprime borrowers. So the prime borrowers are the good people with the good credit quality. But when the good credit quality people are already taken as much as possible amount of loans, then the commercial bank tend to borrow money or to lend money for the people with bad or compared to the prime borrowers. Now they issued the money or the loans to the subprime borrowers. So the subprime borrowers means the people with the somewhat bad credit quality. They say that at that time they even made loans called ninja loans. So the loans they issued for the subprime borrowers were called as ninja loans. That means without documents of income, jobs or asset base, they just suddenly issued the loan to that subprime borrowers due to this asset price bubble because they know for sure the housing prices are increasing. In case the subprime borrowers default, that's okay. They can sell the house and cover the loan. That's what the bank thought. And also, apart from the ninja loans, they issue adjustable rate mortgages to the subprime borrowers. We call them ARM, adjustable rate mortgages. So what is that adjustable rate mortgages? Initially, they allow the borrowers to pay less. Initially, they allow borrowers to pay less. Then later they add the difference to the remaining portion of the loan. Initial year, they allow borrower to pay less and add the difference to the loan and compound the interest rate, which increase the amount that borrowers own once the initial years had passed. So the later they have to pay a higher amount, but initially they gave them concessionary rates. So that's this ARM, adjustable rate mortgages. So all these facilities were used to encourage the borrowers to take more and more loans. So from prime borrowers, they shift to the subprime borrowers with bad credit quality or bad credit history. So then, the third reason, I told you the innovations. So when I started to discuss this global financial crisis, I told you there were three reasons. First one, lower interest rate. Now I explained it, how the lower interest rate created the asset price bubble and the credit bubble. The second reason is the deterioration in the lending standard. Now I explained how the mortgage market shifted from prime borrowers to subprime borrowers with this ninja loans and adjustable rate mortgages. Then thirdly, the financial innovations and their lack of transparency made the global financial crisis. Now we are going to explain that. What is this lack of transparency happened because of this financial innovation? Now, what these banks did that time, they introduced a financial innovation called securitization. Securitization. In the securitization, what they did, they changed the bank's business model. Alright? They changed the bank business model. What they did, they make loans, and all these loans they bundle together and sold them as a package. Can you understand? Now the bank, now suppose that you are the mortgage, the borrowers, I am the bank. Now you want to purchase your house. Now you come to me and ask me the money or borrow the money from me. I lend you money. That is the mortgage. Then what I did as the bank, I combined or bundled all of your loans together and sold that loan to a third party as a package. That is the securitization. Thereby, I removed the loans from my balance sheet. When I sell all my loans for a third party, then there is no obligation in my balance sheet. I removed them. Because of that, I have less incentive to be careful about the loans. Why? Because now what I am doing, I am making the loans and I am bundling them together and selling to a third party. Can you remember? I explained this currency, the credit swap options, credit default swaps. Similarly, here also I made the loan, then I collected all them together into a bundle and sell the bundle to another party. Then I do not have obligation with you. If you default, the party who get the problem is that third party who purchased the loan from me. Right? Then the bank has less incentive to be careful about the loans. What they did, they made loans as many as possible to gain fees and commissions from the packaging loans. Right? What they did, they issued as many as possible loans because they do not worry about whether the people are going to default the loans or not, because they bundle the loan and sell it to another party. So the another parties are investors. They invest in these mortgages and your interest payment and the repayment of the principal goes to that party. I made commissions and the fees from the packaging loans as the bank. So that was the securitization financial innovation, which was emerged during this global financial crisis, or during this housing mortgage market asset price bubble. Now, we package the individual housing loans into a pool and sell the securities backed by the pool of the housing loans to the investors. It can be in US or it can be abroad as well. So that's how it become global. From US financial crisis, it emerged to the global finance crisis because of this financial innovation called securitization. How? Because the investors who bought these packages or pool of mortgages were not only from US but also from other countries as well. The people from the other countries also invest in this particular securitization derivative or the financial innovation called securitization, asset-backed securitization. Right? Now, but that investors who purchase this pool of mortgages, from where they earn the what is their investment or the revenue? That is, they paid interest income to the investors based on the interest income pooled from the housing loans. Clear? Now, you are the mortgage borrowers. You want to buy home, you come to me. I am the bank. Now I give you the loan, and for that you pay me interest rate and the part of principal. But I combined all of your mortgages together and made it a pool, and I allowed people from USA and other countries to invest in that mortgage. I sell them to them. For that, your interest payment and the other principal payment that you pay, I transfer to that investors. Right? So I earn a commission and a fee by bundling these packages. So that's what happened under this securitization. So it was a way to diversify the default risk. Right? Now, because of this securitization, individual housing loan interest rate become more ignored. Why? Because when one particular individual borrower default, it did not create a big impact on me or the investor. Why? Because all the borrowers are pooled now. So even though one particular person failed or default the loan, the income coming from the other borrowers within the pool compromise that. So the failure of one particular individual borrower did not create a huge impact on the system. So later, this pool of borrowers further sliced into different tranches based on the level of risk. First, what I did, I pooled you together and sell it to the investors. Later, that also got advanced. I pooled this pool of borrowers further sliced into the tranches depending on the risk. I categorize you within the pool into different tranches. Low risk mortgages, medium risk, high risk borrowers. Likewise, within the pool, sub-tranches. Accordingly, if one person invests, or that means the third party, if they invest in a high risk tranche, then they will earn a higher premium. because they have a higher risk of default, right? So if a housing borrower default, buyer of this junior tranche have to absorb the losses. Anyway, even though they have to absorb the loss, they compensate that loss by receiving a higher interest rate from the pool. Are you clear? Now, because of this securitization, the risk was diversified and it spread from US to the global context as well. I issued the loan, I bundle them together and sell it to a third party. Depending on your risk status, I slice that pool into several tranches and depending on the risk level, higher premium or lesser premium goes to that third party. So that was the nature of this securitization. So this pooling and slicing of housing loans made it very difficult for investors to accurately gauge the risk. Why? Now it's a huge pool. Many of the borrowers are within the pool. If one is having a higher default risk, that is not visible due to the others in the pool. If others pay reliably, that one particular person's default risk is not highlighted. So these investors did not able to correctly anticipate the risk within the pool because in compensation they got the higher risk. So that resulted this subprime crisis. Then people started to default the risk. Now you know the situation. What happened? Because of the low interest rate, there was a housing asset price bubble and a credit bubble. And then again, because of the deterioration of the credit quality, loans were given to the subprime mortgages also, subprime borrowers also, which have uncertain credit history. Then what happened? Due to the increase in demand for this housing and all, later they introduced a financial innovation called securitization by allowing third party to invest in these mortgages by selling them the mortgage borrowers by pooling them and slicing the pool into tranches. Right? Now that is the situation. Now what happened? How this crisis happened? So far there was not a crisis. So far that is the situation in the US. Then suddenly what happened? There was an inflationary threat in the economy imposed from the fuel price hike in the US because of the rising fuel or the fast rising oil prices. Inflationary threat was there in the economy. To prevent from the inflationary threat, central bank increased the policy interest rate. Previously, it was at a very lower rate. Now they increase the interest rate. Right? Now already we discussed how when the monetary policy changed from the flexible to tight monetary policy, how the asset prices bubbles are converted into bubble burst, right? Similarly, that happened in the US also. So this, because of the higher federal interest rate, then asset price bubble burst happened. Why? When the interest rate is higher, taking loans is costlier. Now the people do not take loan because of the higher cost and the demand for the real assets is low. Now they do not demand more houses. Then what happened in the houses, the prices of the houses? When the demand is low, the prices of the houses are also getting low. That means the prices are decreasing. When the prices are decreasing, what happened? There is a capital loss for the borrowers. They purchase their house with a higher price, at a higher price, now the price of the house is lower. Then ultimately it became, they used the borrowed money to purchase that house now. Then that the worth of their loan is higher than the worth of the house. Are you clear what happened? The worth of the house is now lower because of the decline in prices. But their debt value or their borrowed money was, the mortgage value is higher. Obviously then it resulted default risk because the repayment of the loan is now costlier for them. They have a lower valued house with them but a higher valued loan to pay. Then they started to default because anyway those are subprime borrowers with bad credit history. So they borrowed. So they defaulted. When they started to default these mortgages, what happened? Now the bank can get back the house and sell it. But can they sell it? Can they sell that house at a higher price? No. The prices are lower in the economy. Then what happened? There are too many houses that taken back by the banks, but they couldn't sell it and cover the loan. Right? Now that securitization or asset-backed securities, that people, the third party who invested in this pool of mortgages, they started to suffer. Are you clear what happened? The story. So then you can, here in the LMS, I again uploaded a YouTube video, documentary video, a good one, which is explaining in detail how the banks collapses, how the crisis started, likewise. So please watch that video also, then you can get an idea how this subprime crisis resulted with huge impact in the economy. So the bank failed, so the many very big banks like Lehman Brothers, a very prominent investment bank in US, a global bank, investment bank, they announced bankruptcy. So the many banks failed, many institutions collapsed, unemployment, every consequences emerged after collapsing the subprime mortgage market. So please read about what happened to AIG, what happened to Bear Stearns, what happened to Northern Bank, Northern Rock British Bank, we say. Please refer all these institutions. The famous stories are there, what happened to these particular companies and banks during the global financial crisis. So that's what happened during the financial crisis. Okay, Northern Rock Bank, and the story of the American International Group, AIG, all stories explain how the financial crisis resulted an impact on the day-to-day lives, the job market, and the financial system, and how it spreaded to the other countries as well. Right? So, the one of reason for this financial crisis is the poor credit rating. Normally, when the investors invest in some particular derivative or a financial innovation, they assess the risk of that particular innovation, right? Similarly, in the securitization also, the investors, before buying this pool of mortgages, they assess the risk. They assess the risk, rely on the ratings provided by the credit rating agencies. But for these credit rating agencies, they did not have latest information. Why? Because the securitization was a very new, novel concept. So based on the prime mortgages statistics, they consider this is also have a good credit rate, AAA credit rating. But they did not aware that what will happen, the statistics should be different with the subprime mortgages. They gave the ratings based on the prime mortgages. That means the people with a good credit history. But they did not have the information to inform to announce the ratings based on the subprime mortgages. So that's what happened. Poor credit rating also resulted these investors to excessively invest in this securitization. So here you can read these weaknesses of the banks. I already explained that during the story of the global financial crisis, you can read and understand. And the solution. So, what are the solutions that the Federal Reserve Bank or the Central Bank of the USA and the government taken to as a curing method for this global financial crisis? Mainly, they inject the money by quantitative easing, stimulus packages. They inject huge amount of money to help these troubled banks and the financial institutions. That systematically important banks like American International Group and JP Morgan. So these they let Lehman Brothers Investment Bank to collapse, to announce bankruptcy. But some of the other systematically important banks, they protected, they interfered, they introduced these trouble asset relief programs. They cancel some of the liquidations, amalgamations, and government guarantees, stimulus packages, quantitative easing by providing funds. They help out the financial system to stabilize again. So it made a huge cost to the government and the central bank, ultimately to the government to make the crisis normalized again. So that's what happened under the global financial crisis. So are you okay with the global financial crisis? What you have to remember is what is asset price bubble and what is asset price bubble burst, how that happens. How the asset price bubbles and the bubble burst create the financial crisis. For that you have to give the reasoning with the subprime mortgage market and the mistakes created by the financial institutions in the USA to by lending to subprime mortgage markets and the financial innovations like securitization. So that's all about the global financial crisis. So today we discuss what is financial stability, and today we discuss what is financial stability and how the financial crisis happen, characteristics, types of the financial crisis, and later we discuss in detail how the global financial crisis happened. So that's the end of the session 4. Sorry, session 3.